Hi guys, welcome back to my channel. If you're new here, I'm Nicole Swanson and I help people figure out life by providing strategies in money, mindset, entrepreneurship, and wealth creation in general. In today's video, I wanted to tell you some things that people really neglect thinking about when it comes to their credit journey, the processes of building credit, restoring credit, or just managing and leveraging your credit. These are some things that I feel like through the courses of talking to my clients, dealing with my family and my friends, or talking to my colleagues, that it's not quite considered when you're thinking about your credit. Let's jump right into it. Nobody is better than you. They may be luckier than you because they may have a little bit more knowledge that you don't have. But that can change today. It could change tomorrow. Let's get started. The first thing is that people don't think about their credit as being an asset. Your credit is an asset to you. It matures over the course of the time that you have a credit profile established. Instead, people think of credit as just something that they can just use as expendable to them just to help them get from point A to point B or to acquire materials throughout their lifetime. But typically, if you are looking at your credit like that, it is because you're using it as just a method or a way for you to use a tool that replaces money. And wealthy people, rich people, even people who are not wealthy and rich but understand the vast knowledge behind the credit building process knows that the more you nurture your credit, the more time, attention, and the more strategy that you put behind your credit, that you can use it as an asset to continue to leverage and build your life out over a long period of time. Instead of looking at your credit as just something that you're going to use to get materials throughout life, you should be looking at it as a mature asset that is consistently compounding and building and becoming stronger over the course of your life. Because if you know anything about your credit profile, then you know that the longer you have it, the better, right? The more aged the credit profile is, the stronger it is. Then you know that the more accounts you have, the better. So credit mix. You know that the more that you utilize the credit, use it, pay back, the more they give you. And so if you think about it as a whole of what I'm trying to say, the big picture here, then you will consistently compound and compound and compound until you get to a point where you have so much power within your credit that that asset now is available to you to make so many different moves that you want to make in your life, whether that is going to be real estate moves, or you're going to be, purchasing personal assets for yourself, or acquiring different moves that you want to make throughout your lifetime, whatever it is, whether it is an extensive emergency fund or a way that you're just going to continue to invest. You can use your credit profile without ever having to dig into your liquid cash in your bank account. But that's only if you treat it like it is a maturing asset that consistently appreciates for you. Think about it like real estate, because that's how I think about it. I think about my credit profile like I think about my real estate investments, something that is going to consistently mature and compound and build and get stronger and stronger over time. And because of that, it's going to return to me a huge return. And so my leverage, my power there is going to become significantly stronger. So I always say, if you don't really have a need to touch that credit profile, leave it alone, consistently grow it and mature it and use it the way that it is supposed to be used. And if you want me to dive deeper into how to strategically use your credit profile to build wealth, I will do that. Just drop me a comment below and I'll let you know. The next thing I feel like people don't think about when it comes to their credit profile is they put so much emphasis on the credit score itself and not enough emphasis on the credit profile, which is one of those things that I was telling you about in the first point that I was making. You can have an 800 credit score. And I know people who have 800 plus credit scores, but they can't get an approval for the basic things that they want, like buying a house and buying a car. Well, why is that when the goal is to get, 750 to 850 credit scores? Well, the emphasis is too much on the credit score and not enough on the credit profile. Having a couple of credit cards that is the sum of that perfect 800 credit score for you is just not enough. You don't have enough credit mix. The lenders don't know how you spend money. They don't know how you pay back money. All they know is that you have a couple of credit cards and you keep them under control. And that is the contributing factor that is allowing you to be in a perfect credit category, because lenders, they're getting very smart these days. They have AUs, and AUs are automatic underwriters, which is basically AI. So they have software that can detect your buying power, buying behaviors, borrowing behaviors. And it's 150 different criteria that they assess, with about 40 pieces of those criteria being the most important that they assess. And they know automatically out of the gate, because they've trained these models, or they've had someone to train these models, to detect the type of borrower that they feel like you would be. And when you don't have enough information for those models to go on, guess what happens when it's an AI? It's an automatic denial. So gone are the days where you're going to find that a lot of people are doing manual underwriting, or they have manual underwriters to really depict the type of borrower that you are. They're using systems and machines and AI programs now. And so it's going to get tougher and tougher for you. Now, on the other hand, it could be easier for you when you have everything together. You don't have to worry about a human going to dig through your things, and then the room for error is there, because the computer is set up to reach data points. And if you hit all the data points, then you get an easy approval, which is, to me, a lot better than having a manual underwriter. The only time I would want a manual underwriter is if, like, I need to explain a case, and it's, if I explain my case, maybe I can push an approval through. But, you always have the opportunity to call in and speak to someone about your specific situations. But don't give the people a problem. Start to put the emphasis on building a credit profile out. So instead of going to get a new credit card or another credit card, think about mixing up your credit. Think about putting a small vehicle loan on the credit, or getting an installment loan to put on the credit. People need to see how you pay back money that you actually borrow, instead of just credit cards that you're actually swiping. All right. The other thing is about authorized users. Now, I'm a fan of authorized users, and I am in favor of using them to get the credit profile started, especially when it comes to young individuals or individuals who don't have credit. It's a perfect way for you to go ahead and establish a credit reporting profile, get a credit score up there so that you can get some small primary accounts reporting on your own, and then start to build up your own credit age and, compound your credit accounts. But the credit is a thing that you have to think about. It's meant to be utilized by the individual. So when you're relying heavily on authorized users, or again, AUs, right? We said AUs was also automatic underwriting. Both mean the same. When you're relying on authorized users to carry the credit profile, it's just not strong enough. Like, it's not enough for you to stand on to get major money. So if you just out here and you just want something like a $1,500 credit card, $500 credit card, maybe that'll work for you, especially if you don't have the age, right? If you're someone who was born in 2024, Lord, if you're someone who's born in 2004, and then your authorized user account says that it's 15 years old, they know that you didn't have a credit card at 6 years old. So the underwriters, or the AUs, automatically know this is a red flag AU account that's reporting to this credit profile. So the likelihood of this person having their own credit is probably slim to none, and they're probably receiving the benefits of the score based on that authorized user account. So we cannot give them money. They're getting smarter. So you need to get smarter. Okay. So you don't want to rely heavily on those authorized user accounts to get you to where you want to go. Get it started, utilize it for about 60 days or so, then go ahead and apply for your own primary card to get the credit age reported and get the account established. No subprime cards when you're first starting off building a credit profile, or if you're restoring a credit profile. Leave the subprime cards alone. If you want to know more about subprime cards, just drop subprime in the comments and I'll let you know. But other than that, authorized users are great for starting, but not great for just relying on, or basically using it as a crutch. You are constantly being evaluated by automatic underwriters. These are the systems and the software programs that are usually used by FICO. And if you don't know what FICO is the actual corporation in the business model or the software model that is responsible for generating you a credit score. There are different types of FICO models out there, all the way down from FICO 2, all the way up to FICO 10. So in order for you to know which FICO model that the lender is using to score you, or to weigh your credit score against, you need to ask. There is no other way that you would know unless they specify that to you, or if you ask. So for example, if you're going in to get an auto loan and the lender that is pulling your credit is pulling by FICO 8, but you are looking at your credit scores from FICO 10, something is off there. You need to know what your credit scores are weighed by FICO 8. And so the only way that you would know exactly what that lender is looking at is if you ask them which FICO scoring model are you using, so that you would know then how to go and pull or which FICO scoring model to go and look at. Now, the way that you can go and find these things is just go and look at your credit report and it should break it down for you. I like to go straight to the source. So I use MyFICO for everything. You can go to myfico.com. You can download the MyFICO app. Everything that is related to FICO scorings, FICO scoring systems, software, you can find it on MyFICO. From your scores to your reports, everything and anything. It is real-time reporting. It's about $40-something a month. I believe $43 a month. If you want to actively monitor your report, you get real-time updates every time something is changing on your report, and you get all of your scoring models. But this should also be something that you're able to access with Experian.com as well, because Experian and MyFICO typically are in sync with each other. But you're constantly being evaluated. Your borrowers' behaviors are constantly being evaluated. So, for example, if you have been late on your credit card payments for the last 3 months, well, the FICO scoring model will predict that you will be late on your credit card payments for the next 3 months. And the same can be done if it is 6 months or 8 months. And the same can be done for a positive action. So if you paid your credit card in full for the last 6 months, then the FICO scoring model will predict that you will pay your credit card in full for the next 6 months, and so on and so forth. Now, why does this matter? Well, this is the information that you don't know that's being shared behind the scenes, because before a lender even get a chance to give you an approval, if they're sending you all these offers and they're doing these soft pulls, and by the time they get ready to do the hard pulls, this is the type of information that is also provided to them. So while you're thinking that they're just assessing your credit profile for what you see it to be, they're also assessing the last 24 months of your borrower's behavior. So they're looking at how many times you were late in 24 months from each account on your credit report. They're looking at the likelihood of you being late in the future. They're looking at how many times you paid your bills in full, how many times you carried a balance, and for how long. And those predictive models, they're going to project out your behavior to your lenders who are going to give you more money. So the longer you have negative or derogatory things attached to your credit profile, the longer those bad borrowing behaviors are tied to your credit profile. And each lender who partners with MyFICO or partners with these scoring systems that are the automatic underwriters that evaluate your behaviors, they have access to exactly how you spend your money, how you pay your bills, your relationship with your credit in general. They have access to that, and this is by data points. So it's no matter what you say, they follow the data, they follow the numbers, and whatever the data tells them is what they're going to go on. So if you're having a hard time, even though things look great on your end and you're having a hard time with those approvals or a hard time understanding how to build the strength of your credit profile, think about borrowing behaviors that are being assessed on the back end from the systems that you can't see, because it's always the systems that you can't see that messes you up, from the LexisNexis and the consumer reports and all these systems that are out there that you don't really pay attention to because you're so focused on what they push in front of you. But I want you to know that when it comes to your credit, your borrowing behaviors are also being assessed. Another thing I want you to think about that is often neglected is credit is more favored on the business side than it is for the individual profile. Now, I know that a lot of people are not out here to own businesses and they're not business savvy. They don't desire to have LLCs. They want to go to work, make their money, pay their bills, go home, unproblematic life. Kudos to you, because you are the people who I envy, because I cannot do that. I wish that I could just go to work, make a paycheck, pay my bills, enjoy my life, don't worry about anything. But my entrepreneurial self is just so immersed into business and entrepreneurship that I'm in a state of insanity right now. Okay. But when you think about it in this aspect of how credit works, businesses are more favored on the credit side than the individual profile. You have the opportunity to consistently do things bigger, faster, and better as a business building credit than you do as an individual. Your limits will be higher. You will have more offers. You can get more things at one time. And the opportunity for you to pay later is greater because interest is often deferred for businesses and they're not often deferred for individuals. I know it seems unfair, right? But hey, when you're a corporation and you're doing business, they reward you for that. So I will always say, even if you're not actively working in an LLC, you should have one open. You should have one that is building credit. You should have one that is creating some type of financial footprint. And on paper, it looks like a running corporation or AKA a shell company. But these are the things that you should think about when you're trying to do things in a way where you want to use credit and leverage credit to invest, or leverage credit to fund your life, leverage credit to start the wealth creation process when you don't have any cash. These are the things that you should be strategically focusing your efforts on, because these are the things that is going to help give you the leverage without you having to beg, borrow, and still, rob Peter to pay Paul, as they say. You can just leverage building a credit profile, use the credit, liquidate the cards, pull the money off. The interest is deferred by 9 to 12 months, so you only have to pay back the minimum payment before penalty. You have to think about these things. So yeah, business credit is often favored more than individual credit. And if I were you, I would consistently grow both at the same time to strengthen my credit leverage abilities and what I'm able to do with the funds that I have. And it goes on and on and on and deeper than that, because I would take that money, dump it into a life insurance policy that creates dividends, borrow against my policy up to 90%, run it through my business accounts where I'm getting credit on 3 different ends. And now I have a consistent way to engineer money that I didn't start with. I started with zero. And now I have thousands and hundreds of thousands of dollars that I've consistently been able to collect and compound. So think about that. All right. Think about it. Remember, my goal here is just to help you to think different about everything that you're doing. Don't go into something thinking about it the way that it is presented in front of you, because I'm here to tell you that it is never that way. Whatever you think it is, you need to be asking yourself, what else is here that I'm not seeing? What else is here that I'm not paying attention to? What are they not telling me? And then that should take you down a rabbit hole in which you're able to go and research and find ways and see what other people are doing out there, and see what other people's experiences are, see what books that you can read on the subject matter. Because when I tell you, my mind was blown when I find some of these things out years ago, and I've been able to consistently utilize the systems that they really put in front of you. They put them there. They're not secretive. They're just not right in front of your face, right? It's like the fine print. They'll put everything else in bold print, box it out, underline it, highlight it for you. They'll make it in bigger, legible writing. And then the stuff that they really don't really want you to know, they'll put it down at the bottom in this small print, italicized, and you need a magnifying glass to look at it. And it's not a secret. It's there, but you just didn't pay attention to it because you didn't want to read that small writing. It looked like it was just, whatever. It's like the terms and agreements that nobody reads, and everybody just click the check box and go on with their business, because nobody reads the terms and conditions, the terms and agreements. Like nobody do, myself included. So it's just like that. It's not a secret. It's right there available for you, but you just have to be the person to say, wait a minute, let me go back and let me pay attention and let me look at it. I really wanted to convey this to you today because I wanted you to get to a point where you're looking at your credit different. We all know about credit disputes and affidavits and how we can get a million things off of our credit report. And though I do not do credit restoration or credit repair, I do not mind answering any questions that you have related to such. I know all about it. I know how to do it. I do it for myself. I do it for my family, my sisters, my brothers, or whatever. So I know exactly how this process happens. I know my laws through and through. And if you have a question about it, feel free to always ask me. You can leave a comment. I reply to my comments. You can email me at contact@nicolesmind.com. You can just, however you want to contact me, you can leave your suggestions down below so I can make an entire explanatory video for you. But whatever you do, Be in a situation to where you continuously leverage your credit, build it out, and utilize it in a way that it is going to continue to make you money. Do not use your credit to spend money. Use your credit to make you money, because the point in time where you start to use your credit to spend money, then you start to deplete your opportunities. Your leverage goes from here to here when you're starting to use your credit profile to spend money rather than to make money. So always keep that in your head. How am I going to utilize my credit first that is going to bring me more opportunities and create more assets and create more outcomes for me before I get to the point of enjoying the fruits of my labor? Until next time, guys, if you haven't subscribed yet, go ahead and subscribe. If you found this video helpful, give it a thumbs up, share it with someone who needs to hear this information, and I'll see you on the next video. Bye.